Hi, welcome back to the presentation on financial seismology. This section we're going to talk about pattern creation. Uh, it's our contention these multi-agent systems generate geometric patterns and structure through self-organization. And what we've done is to identify geometry. Here's the basic idea. Complexity theory in a nutshell here. Multi-agent system of investment agents through positive and negative feedback tends to create emergence of geometric patterns and structure. And the cases in nature that we've highlighted here, birds flocking, washboard being created. Nobody makes these washboards, it just happens naturally. And then price channels, trend lines, channels, whatever you'd like to call it, that are not random, where you get 3, 4, 5 points all lining up exactly on a line. You have collinear and parallel segments that form what looks like out of thin air. So the simple rules we talked about in the first slide, the pursuit of price and the attraction and repulsion from prior market extremes, create these are the simple rules that agents would follow, and doing their own thing, they tend to create an emergence of geometry. If anybody's been skiing, you see emergent geometry as moguls. Moguls are self-referential. The ski areas don't create moguls. The snow comes down nice and flat, and it's by skiers coming down and reinforcing structures that prior skiers have used that create these moguls. And interestingly enough, the dynamics of moguls, they tend to move uphill, which is interesting. You should take time and look into that. Actually be interesting to make a movie of such thing. In our markets, we have, again, the occurrence of trend channels, and we define trend channels as periods, non-random periods of time, or non-random structures, I should say, over periods of time that have parallel and collinear segments, and that have been contacted numerous times. So here's an example of some of these. Now, we've introduced log periodicity in our last section. Interestingly enough, log periodicity plays a part in geometry as well. The old technical, I guess, rule of thumb was if you have a trend channel and you break out of it, that you tend to go to a place that is exactly one channel width away. Well, it turns out if you use a log periodic progression of the GAN series, which is 2, 4, 8, 16, 32, then on a convergent basis, half the width of this channel would be marked here, then half of this space would be marked here, would be another quarter, then half again, and half again, and half again. And actually, this log periodic convergent series would converge, if the wavelength is 2, to exactly the channel width of the original channel. So what was a mystery is now solved. So in this case, you've got some interesting dynamic here. You've got this channel with its convergent line over here, and this littler one with its convergent line here, and there's the market going right to it. So again, fascinating discovery. Now, to build these channels, it was about a 3-year project. We created millions of what we call fractional Brownian walks, which are simulated market series, and using the Hurst number, varying the Hurst number, and creating all different series, millions of series of synthetic series of market prices, and then putting what we call a convex hull around them, and looking for how often a parallel or collinear segment occurs. By doing this, we could build up a statistical basis for analyzing real market data, and then we could identify when a channel exists and then look for signals. And we've identified three signal types that are useful with channels. Internal reflections, which are these inside of a channel that's already been designated, and we've just continued the channel lines to the future. So internal reflections I've marked as a 1 here. A breakout I've marked as a 3, and then when the market comes back and touches one of the channel lines that it broke from, we've designated that as a 2. And those have significant predictive power. Not the internal ones don't, but the external ones do. Now here's another slide with some more examples of real internal reflections, and then a breakout here and some retests. I call them external reflections, just science background. And then the movement up to this target line, which is again, if you assume a convergent log periodic, spatial log periodic wave, then the next peak would be here, and the next peak would be here, and the next one here, and it would converge to a point which is exactly a channel width away. And this would be a place where the market would be attracted. And possibly these points along the way, these might be important support and resistance zones. And they have significant predictive edge. The external reflections have a 13% edge for longs, 11% for shorts. Breakouts, 18% for longs and 11% for shorts. Internal reflections, not so much. And I will avoid this one for a moment to talk about. We had an old tool from years ago where we tried to project whether or not market would break out through the top of a channel or the bottom of a channel, and we have a little bit of an edge there. That was used for quite a few years. So I'll end that discussion here. We're going to go on and talk about cycles next, and I'll put that in the next slideshow.